A very good afternoon to all my dear students. Today we are going to discuss our topic of challenger and defender in the subject engineering, economics and industrial management. So, first of all, we'll start with the topic introduction, that what do you mean by a challenger and what do you mean by a defender. So, we'll start with the introduction part. It is used determining whether an existing asset should be replaced with a new asset or not. Basically, in case, as we discussed in the previous lecture, replacement studies also we discussed it, that we need to replace certain articles. Sometimes we need to replace certain articles because of their deterioration, degradation, and so many things, so many factors are there which are responsible for replacement that we discussed in the last lecture. Now if we make a decision to replace certain items, we make a decision that I need to replace this article with a new asset. My old asset is very getting old, it is not working properly and I need to replace the new asset. Then I need to put a more effort. I should need to know the points, that why my new asset which I'm going to buy is going to be better, and in how many terms it is going to be better than the old asset. That should be very much clear in my mind, that if I'm going to replace the old asset with a new asset, then what are the various points that will be there which will be making my new asset better as compared to the old asset. Okay, so the existing asset is known as the defender. Existing asset means the asset which is already there with me, or the old asset which I am planning to be replaced with. The old asset or the existing asset is known as your defender. Now, why it is termed as defender? Because it need to defend itself. It's like a courtroom where the criminal has to defend himself from the judge or from the lawyer, that no, I am not the punishable thing, or no, I need not to be punished, I'm not a culprit. So that is exactly, this is a defender. So in that case, criminal try to defend himself. So that is the same case over is here for our asset study, that if we need to have a defender, what are the various terms that a defender should keep in mind while it is defending itself. Like existing asset or the old asset is trying to defend itself from the new asset. Why we are trying, actually defender and challenger both are the man-made terms, because the machines can't talk, they can't they can't create emotions, they can't tell that I am better and that is not better, they can't tell that those things. We have to decide that if I am buying a new asset, then how this new asset is better for me as compared to old asset, how this is going to be better for me. This should be known to me. Basically, this is what I need to know. Okay, so defender is basically the existing asset or the old asset, and the challenger is the new asset. And the challenger is what? It is a new asset. A new asset or the new asset which I'm going to buy or which I'm going to replace it with the old asset. Okay, that is your new asset is your challenger. So we need to understand these two terms in a very adequate way, in a very proper way, so that we can get them replaced or we can get them known. So new asset is a challenger and old asset or existing asset is termed as your defender. Now, what are the various reasons for replacement? Because it is these terms are basically related with the replacement studies. We can't make them different from replacement studies. We need to understand replacement studies and we can understand these two terms. So we need to understand replacement firstly. Why we need to replace the old asset with a new asset, first of all. So first point, there would be deterioration. There is a common term, deterioration, that I'm going to replace my old asset with a new asset because my old asset has become deteriorated now. It is not in use. It is not further in use because of its old shape, because of its old out-fashioned designs and outdated machinery, or it is not working properly. It is getting repaired after second day. So that there are so many reasons. Deterioration means with time the machinery parts have become weakened up. They are not working properly. They are getting damaged day by day. So there are so many reasons for which I need to replace my old asset with a new asset. Okay. So higher operation and maintenance cost. O&M means operation and maintenance cost. That is the biggest reason basically why I need to make my replacements, because there are so many, because it's higher end operation maintenance cost and less reliability than the anticipated. There is a huge amount of operation maintenance cost. Reliability is very less and anticipation is also very less. Requirement change. We require a change. First of all, deterioration is a main point. We need to get it. Our old machinery is very much degradable position. It is getting degraded day by day. It is not in a position to work properly. The parts of machine are in a properly jammed position. They are completely jammed. They are not working. So deterioration is one of the highest point. Then the higher operation and maintenance cost. The operation and maintenance cost is also very high. Okay, reliability is very less. Operation maintenance cost means I need to get it repaired very soon. Every second month or every after 15 days, I need to get it maintained. The servicing of machine is there. Operation and maintenance cost is getting high day by day. So that is another reason. Requirement change means I need to make a new one now. I need to change my old asset with a new asset. There is no specific reason for that, but I need a change. But that's it. Sometimes our phone is working in a very proper way. There is no need to change the phone or change the laptop or change the other electronic gadgets, my car or my scooter. They are working in a very good condition, but I need to change them. I have a money and I want to change them because I don't like that model of my car now. I don't like the model of my scooter now. I don't like the model of my this phone now. I need to have a latest updated phones. iPhone. I want i7 phone. But whatever there's a requirement. Requirement change. I don't require this phone now. I require a new one. Or it can be termed in this way also. Previously, I was requiring a computer, but now the requirement has been changed. I need a laptop now. Why? Because my desktop or my computer is fixed to one position. I can't make it portable. My computer is not portable. I can't make it get it replaced, or I can't make it to move from one place to other place. So it is in a fixed position. But I need a thing that is portable, which can be easily portable, which is easily portable, or it can be, I can access that machine at any moment of time. Then I need to buy an iPad or I need to buy a laptop. So that is a requirement change. Previously, there was no requirement of portability, but now I need a requirement. I have a requirement of portability. So my computer or my desktop is not fulfilling my requirement. So I need to make my own requirements and I need to change my requirements now. Then the consumer wants the more, less different technology. So there is sometimes on a industry point of view is also very important over here. Sometimes as an industrialist, as an owner of a company, I am manufacturing certain articles. So my consumer is not in a demand of the things which I am producing right now. They're not liking those things basically. They don't like to have those things anymore now. So there is a change of the requirement. Yes, of course, there's a change of requirement and a change of demand also. So that makes a things in a very change in a very adequate way, or in a very uh, disciplined way we are getting the change. So that is another point which can be discussed over here, that there we have a requirement change and consumer wants more or less different technology, which is not a mere requirement for me previously, but I want that my consumers or my customers want a new thing from me. So I need to make a change in my uh, stop. I need to make a change in my manufacturing things that I'm manufacturing. So our next point is new technology provides new challengers. So new technology provide new challengers means whenever we come across a new technologies. Suppose I was dealing with the old technology. It was 2G, or if we talk about mobile phones. Previously I was talking about 2G technology, I was talking about 3G technology. But right now I'm talking about 4G technologies. But if with the advancement of 4G technologies, what has happened? There are so many new challenges. New challenges are so many. We need to uproot all the old towers. We need to implant the new cell sites of 4G technology, isn't it? Then we need to buy the 4G phones. If I want to put a 4G SIM into my phone should also need to be 4G phone. Because the year 2016, when 4G was launched in India, at that moment of time, least people were having the 4G phone, only 10 to 15%. But whosoever wants to have a 4G SIM or want to access a 4G net, then that person need to have a what? They need to have a 4G phone also. So the people had to buy the 4G phones first, and then they have to buy the 4G SIMs. So a 4G network, a new technology that was came into existence in the year 2016, that was a big challenge for all to come across a new challenges, a new advancements, new technologies. So right now we are heading towards 5G technology now. So it's near about 5 years now where when 4G was launched. But now right now we are heading towards the 5G technologies now. And 5G technology is going to be very much fast as compared to 4G also. So it is the advancement of new technology, new challenges will come across again. Already the work has been implanted, the 5G work is going on, and soon we'll have a 5G networks in our home networks. So that is going to be a next challenge for all of us. So next point is a financing. Financing is, yes, that is the biggest issue. If I need to buy a new asset, if I want to place an old asset with a new asset, I have some financing issues. If I am that much capable to finance myself to a new asset, then only I can buy a new asset. Okay, isn't it? So if I need to buy a new asset, I should be financially strong first so that I can buy it. If I'm not able to buy by myself, I need to get it financed by some of the companies, financing companies who finance the articles, or the banks that who provide loan for say for buying new car, or for buying new cell phones, or for buying the new houses. So that is another issue for which we are required. So for financing is another big issue that is to be resolved, because without financing, we are not able to fetch the new technologies. So better interest rate. Yes, that is another big point over here. Better interest rates is most appropriate. We need to have a good interest rates. We need to have a better interest rates if we want to assess the replacements. Yes, if I want to replace my old asset with a new asset, my new asset should earn me good interest rates. They should give me more profit. I should earn more gain out of my new asset. Then only I'm going to replace my old asset with a new asset. Then reason for replacement, other reason for replacement is outsider and one is your insider. Outsider means conduct analysis, assuming you are an impartial third party. Outsider means conduct analysis means I'm not the exact you know the person who is going to be dealing with the challenger or dealing with the defender. I'm the outsider, I'm a third party person. I'm not directly dealing with the challenger, I'm not directly dealing with the defender, but But right now, my position is not directly, but I'm indirectly involved with this process of replacement. Then is the insider. Insider is a company that is tempting to try and recover the past errors. So then that is another reason that I'm a company and I knew what are the basic errors which my old asset is producing and how to recover, how to overcome those past errors. That is another important point in case of our insider. Then is a more reasons for replacement. Market value should be less than the book value. This is one of the major reasons that whenever we need to replace the thing and we need to have a new asset at our home, we should always have in our mind the market value should always be less than the book value. If I'm selling something, my market value should not be that very high that my customer knows everything. Customer always benchmarks the thing. If I'm buying something from one shop at one moment of time, I will definitely try the same article at some other shop sometime and I will compare the rates. I will compare the value. I will compare the MRPs. That what price that shopkeeper, the previous shopkeeper has taken from me for the same article and what discount the new shop has given to me on the same article. And obviously, the shopkeeper who is giving me good discounts, I will prefer to have that for my future correspondence. So that is going to be another different and very important point in case of your market and book values. Then the capacity of defender is inadequate. Capacity of defender is inadequate means the defender is not in a that no adequate manner that it can defend itself. Yes, of course, sometimes the machinery gets very old. Suppose I have a Activa at my home and that is near about 10 years old. And after 10 years, it is not working properly. After every 7 days, after every 10 days, I'm going with my Activa to a repair shop and getting it repaired. Or after every month, I need to get it serviced. My average has dropped to a very down level that I need to replace it, then that becomes a major reason for replacements. Then these reasons become the major reasons for replacement. So in that case, we can say that my defender is not in a capacity to defend itself. That is not a capacity to make itself safe. No, it's not a capacity. It has been in a totally deteriorated and degradable condition, and it cannot retain itself the quality, it can retain the gain, it can retain the interest to my field now. Then the operation maintenance cost of the defender is higher than anticipated. Yes, of course. The operation maintenance cost has become very higher than expected. I was not expecting such a higher cost, but it has achieved a very higher values. So that becomes a major reason for concern in my case. In that case. Then the losses have occurred but shouldn't be considered for replacement analysis. Some losses have occurred in my old asset or the defender, but I'm not considering it very adequately. I'm not considering it in a very, gentle way or in a very, legitimate way that this is the reason for my replacement because it has given me losses. No, that new machine can also give me losses sometime if it's not being working properly for some time. So it happens sometimes that some machines are not in a working condition, in that good working condition, so it gets damaged. But until or unless my old machine is deteriorated, degraded condition, in a very bad condition, it is out of date, expiry date has got already done over, then I need to replace my new asset. Otherwise, sometimes any new machine can also be getting faulty for some time. The fault can come in a new machine also. That is not sure that new machine will not get faulty. It can get faulty after 1 week only. But we have a guarantee. We have a warranty for that machines and get it replaced, or we get it corrected by the this service providers. So that is another issue. But losses, again, losses, only reason for losses is cannot be the reason that my machine is not working and I'm getting replaced. That is not the adequate reason for that. So that is all with the challenger and defender and its major properties. What is a challenger? What is a defender? How we can replace it and how we can have a selection of replacement, getting it replaced or not. So next topic of our lecture is discounted cash flows. Discounted cash flows is another method for your cash increments or the cash incoming or outgoing, that we need to know that how the cash inflows and how the cash outflows. So we need to know about the this discounted cash flows in this very topic. So let's start with the introduction first. Introduction starts the intrinsic value of the company. What is intrinsic value of the company? The theoretical versus relative value. So first of all, we'll need to know about all of these terms first. What are these basically? Based on unlevered free cash flows. Free cash flows is the FCF, is the free cash flows independent of capital structure. The free cash flows available to all capital holders. It is always available to all the capital holders. The value equals the sum of the present value, unlevered free cash flows, projected terminal values. So what are these terms now, first of all? Theoretical versus relative value, first of all. Now this intrinsic, what do you mean by intrinsic value of a company? Intrinsic means exact or the pure value of a company. What a company basically comprising of. If I'm talking about any company, if I'm talking about any industry, what is the basic terms which a company is comprising of? That I can say, yes, this company is comprising of these terms. This company is comprising of these terms. So what are those basic terms for which I can say that this company is the derivative or the relative value of this company is this much? So all those economical terms will be discussed in this discounted cash flows topic. So let's start with it. Theoretical versus relative value. That's a based. It is based upon unlevered free cash flows, which is not counted basically. I'm just talking about the free cash flows which are not counted and which is going to be in a way that it is going in this way only or it's going in that way only. So it is a level of the free cash flows. It is independent of the capital structure. It is not dependent upon the capital structure. The capital structure is totally independent of its theoretical as well versus the relative value. Free cash flows are available to all the capital holders. Yes, I'm the capital holder. Suppose I have a capital. With capital means money. I have this much money, I have this much capital with me, and I am freely to move my cash flows to any company. Some of it's like a kind of financing companies. I'm having a financing company. I have a company that is going to finance the other companies. They provide a finance to other companies. So in that case, I need to give the finance. So I have a free cash flow that I can get the tenders, get this company need a finance, this company needs a finance, this company needs a finance. So I need to give the finance or the financial help or the cash flows. Cash flow means the amount of cash that can be flowed to one company to other company or other companies in order to cater their needs. So the needs can be catered down. So in that case, we need to have the free cash flows. Then the value equals the sum of the present value means the unlevered free cash flow and the projected terminal value. Now, what is this aim of this present value? First of all, present value is, I mean to say, I'm talking about the free cash flows. Free cash flows means I'm getting the money from this and this. Sometimes we have the chairpersons or we have the holders, the shareholders of a company. who are liable to give or give, provide a finance or a free cash flow facilities being provided by those shareholders. So in that case, that is an unlevered cash, free cash flows. Then we have the projected terminal values. The terminal values which need to be terminalized, or the projected values which are not certain to us, which are not given to us, but we need to pretend that these values are to be used for my system analysis. Then we have the estimated value beyond the forecast period. We have the estimated values which are even beyond the forecast periods. I need to forecast those values first, and then we need to project those values. So that is the other point of our topic. So estimated values, I need to estimate those values which I can't even forecast, which is beyond the forecast period. Suppose, like, the main example for this kind of term can be that I need to give the analysis of my company, the financial analysis of my company, be after 5 years. That after 5 years, my financial status of my company is going to be this much. But I'm not known with the financial status of my company. Na? I can't predict the 5 years plan. Right now, the situation which is going on, we don't know what is going to happen the next moment, isn't it? So which you are facing from past 1.5 year. So that is one thing that is quite unpredictable. So that is the thing. So because on market value is being changed by all the conditions. This present COVID situation has, like, we can take the example of COVID situation, of course, in this case, because the present COVID situation has changed the market to a great level, to a huge level. We were not expecting what has happened, because this has never happened in the history of India or the world, basically. It's a worldwide pandemic, you can say. So what has basically happened over here is we need to channelize, we need to know about the thing, that what is going to be actually happening. We need to predict the things, or we need to calculate the present values which is beyond the estimated value also. I can't estimate that value also. For that, I need to be able predictions, because we never predicted that these sanitizers, these face masks, disposable masks, N95 masks would be in huge demand in the year 20 and 21. We never knew this, because the limited stock of these articles was being made. It is nothing like that. It was not made. We previously also we used to have hand sanitizers. We used to have the face mask, but it was only being used by those persons or by those doctors who are going for operation theater or going to have surgeries, or those patients who are prone to infections. Only those patients were wearing those face masks previously. But nowadays, each and everyone has to wear a face mask if they have to move out of their house. That is a must. So we never predicted this kind of situations, and that is going to be happened. So this is the best example for the estimated value, which is beyond the forecast period. Then the PV calculated by on a discount rate. The present value is always calculated on a discount rate. Yes, the present value is this much and it is on the discount. Then typically the weighted average cost of capital. What is the weighted average cost of capital? Weighted average cost of capital means what was the average cost that was being invested, and what is the average cost that was taken as a turnover of my company. That is with the weighted average cost of capital. Then we have the DCF. DCF is the intrinsic value based on the project FCF, free cash flows. What is the actual value based upon the free cash flows? It is flexible and adaptable analysis. It's very flexible because it can be flown by any of the members of the company or by any of the shareholders. How to change, how do changes in projections impact value? Now, how the changes in projections can impact the value? That is a question now. It can affect the growth rate. Yes, of course, the growth rate can be affected by changes in the projections. Operating margins. Operating margins is another important point that can be typically used for the change that I can see that this is a big change that is coming across when I'm using this the present analysis or the present FCF method or the present flexible method. Then the operating margins of rate, of course. Then is your this synergies, expansion plans, etc. We need to have certain plans, certain new strategies need to be implemented by which we can have our system in a more proper, in a more adequate way. We can use them, we can analyze them. So projections, of course, they make a difference. If I am projecting something, some of my articles to market in a very healthy way, that these articles, these and so articles are going to be beneficial for all the people of society, and those benefits are not given by any other company, then of course my projection towards my project or my article are very healthy, and they are going to put a very positive impact on the customers also. So that is a one important aspect of the analysis of the project, that it is a growth rate. It can affect my growth rate also. I can grow in very small time if I'm inventing or if I'm projecting certain things which are not given or which are not projected by other companies, then it can definitely affect my growth rates. Operating margins can also be improved. Operating margins, yes, my operating margins can be improved to a very huge effect if I'm talking about the new things or the new modulations which I've put in my new articles. Synergy expansion plugs, etc. plus can be included, and as plans can be included in these. We can have the involvement of new plans in our existing assets or existing plans. The objective calculation through PV. My objectives of calculation through the present value will be there. It may require scrutinies. The scrutinies can be a major reason for the requirement over here. In this case, I need to scrutinize my whole system. Okay, it is always obtainable. It should always be obtainable. It is nothing like that it is available today, but it's not going to be available tomorrow. It should be in such a position that it can be obtainable every day. It is always obtainable. That is a major point over here. Then DCF is the cash flows from the forecast, possible bias, run sensitivities, reliabilities. So cash flows are from the forecast. Okay, cash flows are for the forecast that this is going to be a huge success in the coming time. Yes, the company owners, the industry owners, they have a forecasting issues. They always forecast the things in before that this company, that these articles which are being manufactured by so and so company is going to be a huge success in the coming time. So these all things happen actually in the industry. The possible bias or the run sensitivities, these are going to possible biases for the main. If of course if I am running a new project, if I'm launching some new projects in the market, then of course my competitors will have a problem with it. They're going to have biased. They will feel that these things are going to be a threat for them. So the issues are going to be created for that moment of time. Reliability is one of the major issues. It should be reliable. If I'm launching a new thing, it should be tested, it should be reliable, and it should be affirmative that these things are not going to put any bad impact on the customers who are going to buy this. So subjective valuations is there based on numerous assumptions. We are making so many subjective assumptions that this is going to be a beneficial for my system in many ways. Then highly sensitive to changes in FCFs, that is free cash flows, the growth rates and margin assumptions, the estimated terminal values and the assumed discount rates. the beta market rates, they are all going to be a very huge market points or the huge points which are going to be analyzed when we talk about the new things, new projects which are going to be launched in the market. We are going to face them in a highly sensitive way. So that should be prepared for all those things. Then methodology steps for a DCF, that is discounted cash flows. What is the methodology that we're going to follow for the discounted cash flows? First of all, we need to estimate the cost of capital. We need to know the cost of capital. What is my cost of capital, which I'm going to invest? How much is my investment? I need to get the forecast of free cash flows. I need to know that how much I'm going to earn the profit out of it. Calculate the present values. I need to calculate the present values, that what is the exact present value of the article which I'm going to launch in future. Estimate the terminal value. I need to put the last point that these are my terminal values or the end values which I'm going to launch in the market. I need to derive an implied valuation range. There should be a derivation of an implied valuation range, that these are the valuation ranges and they need to be implied in a very appropriate way in the market. So that is another important point. Then we have the sources for forecasting the free cash flows. How we can actually forecast the free cash flows? We can use the standalone model projection for DCF and free cash flow projections. We can make a model displays. Yes, this is my model. This is my project analysis by which I can actually show that how this is going to be a huge benefit or a huge profit for all of us in future. Alternative cases to assess. We need to assess all the alternative cases, that if this model will not work, I have some alternative models which I'm going to replace at those time when my existing model is not in a working condition. So I should always have alternative cases into my mind before assessing the new ones. Then I need to know the upside potential. I need to know that how much is my actual potential for that very cash flows. I need to know the download risk also. What is the upside potential means? What is a huge amount of profit that I'm going to get? The predictable amount of profit that I'm going to get, and downside risk means at the same time what is the losses that I'm going to bear. I may bear by the use of these free cash flows. What are the synergies usually treated as separate analysis? Consider a steady state forecast horizon. I need to have a steady state basically. If I may not get a very huge profit, I may not get a huge gain, but if I'm not getting a loss also now, then at least I'm in a steady state. And I need to maintain a steady state for my transactions. That is a major thing. Then the cash flows can be sustained forever. Cash flows can be made sustained, stable growth can be there if we maintain the quality, if we maintain the good position with our good rapport with our customers. Then we can have a sustained quality of cash flows forever. Then generally viewed not to exceed the economic growth rate. We have generally seen that the growth rate need not to be exceeded to a certain level. We need not exceed our growth rate to a certain level. So that is one of the major point that to be kept into mind to while designing or while forecasting the free cash flows. Then we have the multi-stage projections. Multi-stage projection is also another projection point that is needed to be understood with the free cash flow concept, and it is a very important concept whenever we talk about it. So first point in the multi-stage projection is the forecast for a horizon potentially can be in stages. Now the forecast horizon can be in stages. Yes, it can be stage 1, stage 2, stage 3. Yes, it can be like that also. Which is nothing like that. that if I'm projecting something, if I'm saying something, yes, this is the actual horizon for my company, or this is the actual thing that I need to know in, or which I'm forecasting for my project or for my article in future, and this is not going to be changed. It is nothing like that. It can be changed to a huge amount in coming future also. So it can be changed or it can be forecasted in stages also. That stage one, after 6 months, it can be like this. After 6 months, it can be like this. So the changes can be in the stage wise also. It is not predictable for a complete year. Concept slow growth over time to steady state. It can have a concept of slow growth. The growth rate is very slow in case of your multi-stage projections. We can't have a very huge or we can't have a very high projections for the this multi-stage projection analysis. It is slow and steady. How long does it take to achieve the steady state? Now this is important. How long actually it is taking? How long a project is taking to achieve a steady state? Steady state means when the profit and loss are at some par with each other. We're not getting so high profits and not any loss also. So that is a steady state. A length varies by industry and situation. Yes, of course. The length of my projection, it varies with the it varies with what? It varies with the industry and the situation in which it is working. Actually, it is working in which situation, that is the main major point over here. It is a major point of concern when we talk about the multi-stage projections. Then does the company have a sustainable advantages? This is another point. From the customer point of view also, it is very important. We always, whenever we need to buy any new thing, we always look at the company first. Okay, this is from this and so company. Yes, it's a reputed company, but so the product will also be a good one. So this is a kind of a thing that comes from automatically. Yet we see a company, we see the logo of a company, we see the brand of that company, and we make a point. Yes, this company is a reliable company, and we can go through this company articles. That is a very major point when we talk about any of the analysis of the this growth stage. Then the growth from a single product with a protected position. We need to know that how we can grow from a single product. If we are buying or if we are manufacturing only a single product, then how can we judge our growth from a single product? That is another issue. Generally speaking, as growth nears stable growth, risk and capacity needs decline. We need to have a stable growth, then the risk of the capacity need decline. The risk becomes less in that case if the growth is always stable. It is always closer to industry average. It is always closer to the industry average rate to which it is approximating for the multi-stage projections. Then finally, a DCF analysis give us what? They compare the DCF result with the current stock price. We derive a reasonable defensible range. We require the reasonable defensible range for our DCF analysis. A range of discount rates is there. We need to have a discount rates over which we can actually calculate our DCFs. The range of exit multiples are there, perpetuity growth rates are there. Okay, weigh the DCF, we actually weigh the discount cash flow results from heavily when comparable analysis are not as applicable. So we need to compare the analysis with the previous ones. No pure play public comps or acquisition comps are there. There is no pure play. It's basically a complete analysis, a complete comparison of the previous one with the new one. We need to have a common to see various scenarios. We need to have a scenario that is common to all the cases. It can be initial cases or it can be the other cases. So what are the international issues with the cost of capital? The risk will carry from country to country. if I need to make my company or make my products available internationally, then the major risk in that case is the country to country my risk will vary. Maybe that country people will not like my products. They can give me some threats. They can pursue me. They can sue me. So that ways there are so many risks because the norms, the rules, the regulation of the company, the products is changing from country to country. So it is international level, the risk factor is very high. Then we need to calculate the cost of capital internationally, more challenging. We can have a most challenging job for the calculation of cost of capital when we talk about the international values. A limited data of international strata is there with us. A lack of integrated markets is there. We don't have any links with those markets. Emerging markets even more difficult. The new markets are, it's going to be very difficult for the new markets to make themselves stable in those international standards because international people, the other country people may be using some other international products of their own country. So if I'm launching some of my products of my own country into their company, so I'm a new emerging market for them. So the huge risk is there for me to sustain myself in that huge market, well established markets basically. So we need to have a possible to obtain country specific assumptions over there. We need to have a possibly how we can actually assume or how we can actually obtain the country specific assumptions that is to be maintained and that to be needed to be known when we talk about these possible assumptions. Then the equity risk, premium and betas is always there. The risk free rate is always there for such as UK tertiary 10-year bond, we can have a 10-year bond with them. Like some countries, they sign a bondage that yes, I'm going to tie up with you and you can sell our products to us and it's our responsibility to bear the losses and profits for those. So that is a kind of bondage. Us in that case, if you make a bond with certain countries, then that becomes a risk free for us. We don't have a risk of any losses in that cases. We can have a seek specialist and internal resources. We can take the help of specialist and internal resources for our other issues of our capital. So that is all about the discounted cash flows and its emerging trends and how to sustain ourselves in the coming market. Thank you so much for your patience.